Today we're going to be looking at cable, at the pound versus the dollar, because it's just sunk to its lowest price since March. And then we're going to talk about something called credit spreads. What are they? Why are they important? And why, in context of this current market, do they matter hugely? And then for the trade and takeout, we're going to focus on why it's really important for your trading to always have a view. In order to get the best insights, daily news and education, you need to be here every day. So click subscribe now so that you can trade your edge every day. Now, for those of us paying attention over the last couple of weeks, which I hope is everybody, this should be of no surprise that sterling and pretty much all dollar pairs are in decline versus the dollar. It's going through a period of absolute huge strength at the moment. And I think the euro even has had 14 weeks of red candles or red prints. That might be a bad statistic, but it's something like there's a good good number of weeks where the euro is pretty red now. But beyond the point, you can see the trajectory that it's kind of going off of. This is a sterling chart. This is cable. So the pound versus the dollar. And you can really see that it's got its giddy up since Powell's comments from last week. At the start of this week, it's fallen off again by another 100 ticks. Last week, it was down by 1.15%, which is, a relatively large move for an FX pair. Powell's comments last week, just to reiterate, were that his base case isn't for a soft landing. So he's expecting a hard landing. My view is that it's going to require unemployment to start ticking up. It's going to require NFPs to start printing, really, really poorly below expectations for that to really come to fruition. But at the moment, it's one-way traffic for the dollar. The dollar is very much bid against pretty much every pair, whether it's the yen, whether it's, sterling, euro, CAD even. And it doesn't seem to be letting up, which poses a real problem for risk. And one of the reasons why the pound is moving so strongly as well is because we've had this duration selling. So long duration has sold off. That means long end of the yield curve has been sold off, which means that the yields bid, but also so have tech stocks. Now, the pound is very, very sensitive to US equities because 75% basically of the FTSE, for example, is done in USD, and it's just a hugely rate sensitive risk sensitive currency. So you tend to see outliers in the pound versus other currencies when things do start moving. It's kind of you're trading one risk off side of things when you're long the dollar, and you're selling the risk on sentiment of the pound. Which is very much sensitive to the risk environment. Overall, though, I think what's going to happen from here is we're going to start seeing a softening of rate talk generally, especially in the UK. I think that the Bank of England are in a very, very protectionist stance over the property sector, and they recognise that that print in July of negative 0.5% growth is niggling in the back of their mind, and how closely related GDP growth is to property price growth. So I think there's going to be some figures coming out on Friday. I believe it is the nationwide house price index, and also the quarter-on-quarter growth numbers too, which will be massively important, for the next meeting. But I think we're near terminal rates in the UK, which is also causing a softening of sterling here. Targets, well, at the current price, you'd probably want to say about 1.2 is where sterling's going to go, which is about 150 ticks away from current market price. I don't think there's anything really to cause issues pushing down to where we were at the LDI fiasco. I think there's support here at 1.14-ish. So that they're kind of the longer term downside targets that I'd be paying attention to. But near term, probably, 1.2 is a nice target to look at. Now, here's a bit of an interesting part of the market that probably not a lot in the retail sphere speak about. And this is the credit markets. And it's predominantly like that because to trade credit, you need to be a sophisticated investor. Minimum clip size is like $100,000 usually, or whichever unit of currency you tend to buy the issuance in. But something interesting's happened over the last week or so. Now, if we look down here, we can see that there's been a big spike up. I think, firstly, what is a credit spread? Well, a credit spread is the difference between the risk-free rate and the average spread within a certain segment. So within credit, you've got AAA rated all the way down to, junk bonds. And here we're looking at the high yield index. So AAA rated is your really, really secure stuff. You're definitely not going to get a default on it. Down to your high yield, which is priced a lot higher to compensate for the additional risk. Now, what we've seen over the last, 5-6 days is there's been a spike up to the highest level since August in the high yield credit spread segment of the data. And what this basically means is that there's been some kind of tick up in default risk. If you were to zoom out, though, it's not been huge. But the key is that the volatility has increased. You can see that since July, it's been relatively flat. Now that volatility has ticked up. So what does that indicate? The more common thing to look at for you guys would be to look at the VIX. Now, the VIX through the same period has been very flat too, but it's just ticked above 19 yesterday. That is the highest since June, I believe. May, highest since May. Okay. And this is showing, I'm not going to get into the very specifics of it. It's basically a variance swap that shows where the S&P 500's volatility will look to trade in the next 30 days. So it's a bit of a calculation done on various different expiries of options to try and come up with a number of, okay, in 30 days, this is where we expect the market to be. Do we expect it to be more volatile, irrespective of direction, or less volatile, which it has been here? So here is obviously least volatile, nice and flat. You can probably just stay long. But now since we've seen Powell speak and, create that event-driven risk, we've seen the VIX spike up because people are more uncertain as to the direction of the S&P 500 over the next 30 days. Hope that makes sense. But the same applies for credit spreads. So let's go back there. Because credit spreads are heavily derived off of, equity pricing as well. If things are deemed to be worse in equities land, then credit risk is going to spike. People are going to start perceiving companies to be more likely of default, especially in the high yield segment. So where people are taking more risk to compensate for the perceived default risk. This is definitely something to watch. This is something that, more institutional people would look at. Credit spreads are very, very important. And you can access them on TradingView. You just type in BAML, which is Bank of America Merrill Lynch. Then there's various different assets that you can choose to look at there. So you've got the corporate index option adjusted spread, which is the entirety of the market. You've got single A, triple C and lower. And you've got your AAA here as well. So if you look at the AAA, you can see that it's completely different. So the high yield segment has spiked up, but the AAA segment is actually trending much, much lower. Something I'm a massive advocate of is always including the macro, if you haven't noticed already, into your trading style. I think that by always having a view, you're allowing yourself to be receptive to new information, and you're allowing yourself to, be more nimble and move with the times in the context of the market. Because if there were no events going on, if there were no economic data, those technicals just would not matter.